A portfolio rebalancing is the process of adjusting the weightings of assets in a portfolio with the very sole aim of maintaining a desired level of risk and return. So over time, due to market and fluctuation, certain assets may outperform while others may underperform, leading to a kind of imbalance in the portfolio. So rebalancing involves buying or selling assets to bring the portfolio back, in line with the investors' original or updated asset allocation strategy. It is done to be able to balance the portfolio so as to obtain the desired investment goals or objective that the investor must have set for himself. We want to examine key features of portfolio rebalancing, key features of portfolio rebalancing. Number one, we have asset allocation maintenance. Asset allocation maintenance. Rebalancing helps maintain the target asset allocation, such as the ratio between stocks, bonds, and even cash, based on the investor's risk tolerance as well as his or her investment goals. Number two is adjusting for market movements. Adjusting for market movement. As some investors grow faster than others, you discover that some investments actually tends to grow faster than others. So rebalancing ensures that no single asset class dominates the portfolio, and by so doing, you discover that there is that maintenance of adequate diversification within the portfolio. Number two is risk management. Number three, rather, is risk management. Risk management. And so regular rebalancing helps manage risk by preventing the portfolio from becoming too heavily weighted in one sector or asset class, which could lead to a kind of greater volatility. So it prevents the portfolio from being somewhat overweighted in a particular asset class and underweighted in another asset class. And by so doing, you discover that the level of volatility is somewhat reduced. Number four is discipline and consistency. Discipline and consistency. So it promotes a disciplined approach to investing, ensuring that investors stick to their long-term strategy rather than reacting to short-term market noise or fluctuation. That is, these are the key features of portfolio rebalancing. I want to highlight, how portfolio rebalancing work. How does portfolio rebalancing work? So in this case, we have what is called rebalancing frequency. The frequency, the regularity at which you rebalance your portfolio. So in this case, investors may rebalance their portfolio periodically. Example, may be quarterly, it might be semi-annually, or even annually, as the case may be, or when the weights of any asset class deviates significantly from the target allocation. Typically, if it deviates within the range of 5 to 10%, that particular asset class is due for rebalancing. Once it goes beyond 5% towards 10%, it's necessary you rebalance your portfolio and bring the said asset class to the percentage it was earlier, the percentage at the initial stage. Not only that, rebalancing methods, want to consider, methods of rebalancing. So common methods include time-based rebalancing. It's what is called time-based rebalancing. So adjusting the portfolio at set intervals, regardless of market changes. In this particular concept, there's the portfolio is rebalanced at a predetermined interval, regardless of the nature of the market or what is happening, in the economy. The other one is a threshold-based rebalancing. Threshold-based rebalancing. In this case, rebalancing is done when an asset class deviates from its target allocation by a certain percentage. So let's take for instance now, you have maybe a 40-60 portfolio, 40% bond and 60% equities. If the equity portion goes above 60%, all right, and the bond portion goes below 40%, it's necessary, you may need to rebalance it to be able to get to the initial targets you desired for the portfolio when it comes to the bond, equity percentage or the ratio in the portfolio. Not only that, there's the cash flow rebalancing. So rebalancing here has to do with with new contributions or withdrawals and directing the cash flow into underweighted asset classes. Usually, when a particular asset class produces much cash, you kind of harvest the cash. You take the cash and then put it in an asset class that is somewhat undervalued, or rather is somewhat underweighted in the portfolio. That's what cash flow rebalancing is all about. Let's look at the advantages of portfolio rebalancing. Number one is it maintains risk profile. Is that maintenance of risk profile? It helps investors stay within their preferred risk tolerance. Number two is discipline approach. It prevents emotional decision making and ensures a consistent investment strategy. Number three is it captures gains. It captures gains by selling assets that have appreciated and buying those that have underperformed. Rebalancing can lock in profits while buying low. You buy the underperforming assets at a low price while you sell the outperforming ones at a higher price. That's by so doing, you're able to capture your gain and even channel it into buying something that is considered undervalued. Let's look at the challenges of portfolio rebalancing. There is transaction cost. Actually, there is transaction cost attached to it, associated with this particular strategy. So the balancing may, incur trading fees, and also taxes like capital gain taxes and commissions, which can reduce the overall returns. And then there's the issue of timing. The decision of when to rebalance can be tricky. It's not just a clear-cut, straightforward kind of endeavor. It could be tricky. Over rebalancing can lead to unnecessary cost, while under rebalancing might expose the portfolio to excessive risk. So you just have to maintain a middle-of-the-road policy. You don't overbalance and you don't underbalance. And then lastly, market timing risk. Rebalancing might force investors to sell an asset just before it performs well, or to buy when the market is down. So is that kind of buying or selling at the wrong time for the sake of rebalancing. Okay, you need to take that into consideration and avoid such as much as is necessary.